Hi, everyone. I hope you can hear us or hear me at least. If someone could say that, can you just confirm that if you can hear me?
I can't. So
No, there's no, the microphone's not working. Hi, David.
that's on.
Might get this sorted in a minute. Yes.
Yeah.
Fantastic. Brilliant. Let's start. Well, first of all, apologies for the somewhat chaotic beginning of this live stream. We have been off air for some time, and it takes a bit of time for David and I to get back onto the channel. Right, you have to mute myself. Yeah, not hearing anything. Right.
Well, now I can hear you.
You can hear me now. Yeah, I turned my thing up. Right. Okay. First of all, thank you thank you again for your patience and for being with us today. It's really very much appreciated. Let's just crack on because, as I said, it's our fault. We've wasted so much time. All right. We're going to talk about Forex today. The markets, as you know, have been fairly spectacular. Well, they were spectacular last week, and yesterday they kind of topped it in a way that not many people saw coming. Obviously, you know, there's been a bit of a swoon only in the tech sector, with the announcement and release of the Chinese version of Chat GPT, DeepSeek. Whether that was planned carefully to coincide with this new trade, the first trading week really since the inauguration, who knows? There's all sorts of fun and games that happen in politics and obviously in the markets. But regardless of that, yesterday was a fantastic example of how the insiders, the market makers, take any bit of news and manipulate it and really use it as an opportunity to shake traders and investors out of the market. And of course, the tech story is going to run. But as I said, we're going to focus on Forex in this session. We will do a stock session in the coming weeks. But for the moment, I want to do Forex because obviously the main topic in the Forex market, well, two topics, I suppose, but one of them is the US dollar and its rising strength, although it has come off slightly. And the second is what is the Bank of Japan up to finally raising interest rates, because after 30 years of trying, they now have inflation. It's certainly nothing on the scale that the inflation other countries have seen, but enough for them to move away from negative interest rates and begin gradually to raise interest rates. Now, that is going to cause all sorts of problems for the rest of the financial markets, for the whole monetary system, because those of you who have come to these sessions in the past or have read some of my posts or have some of my book, in particular, the book, The Three-Dimensional Approach to Forex, will know that all the markets are interrelated, and the issue with the Bank of Japan is because they've had these very low interest rates and negative interest rates, their currency has been used to fund risk assets. In other words, you borrow in yen, and you go and buy assets that are yielding a higher return. That is called the carry trade. When that starts to come to an end or comes unstuck, most spectacularly, as we saw with the financial crisis back in 2008, we are really on a very slippery slope to a very big pullback, not just a pullback, a crash. We're talking about a market crash. Was yesterday a market crash? No, because we're just talking about one particular sector, a very important sector of the US markets, and the result was you saw in the fall of the two main indices, which was the S&P 500 and the NASDAQ. And you say, well, if it was only the tech sector, why did those indices fall so spectacularly? And that is another reason for that is how these indices are constructed. They're constructed based on the market cap value of the individual stocks, and they are then given a weighting within that index. And what that happens is that companies that have the biggest market capitalization, being the 7 big tech companies, they carry the biggest weight. I think they carry something like certainly over 30%. The top 10 carry 40%. So so the index is very, very highly concentrated in one particular sector of the market. So when that sector has a day like it had yesterday, it drags everything down. Because if you look at the equivalent, what's called the equal weight of the S&P 500, which is the RSP, that really did quite well yesterday. It went up quite nicely because the tech sector it's an equal weight. No company is given a bigger holding, if you like, in the index. Hence, the overreaction that we had in the two main indices. And what the media does, it uses these indices as a kind of benchmark. So if the S&P is doing badly or the NASDAQ is doing badly, the NASDAQ is mainly tech anyway, that's where you get these awful headlines. It starts to scare people, shake them out of positions. Now, how does that link to the US dollar? Well, the US dollar certainly has a relationship with not just stocks, but also the bond market. And what happens then, you look at the bond market, what were yields doing? Yields were falling and the dollar was falling as well. As soon as yields start going up, the US dollar tends to go up as well. So you have all these relationships between the different markets, and that is something you have to be aware of when you are looking at forex. Forex on the surface seems very, very straightforward, and it is in a way. You're just looking at two economies, two instruments, and you are deciding to take a trade on which is the strongest and which is the weakest. I.e., you're going to buy the strongest and you're going to sell the weakest. And that's what we do in the forex market. We actually have to compare one currency with another. To help us do that, we have David and I use what we call our currency strength indicator. And what this does, it gives us a visual picture of where the flows are going into, where is the money flowing into, which is the currency that is attracting the most flows, which is the currency which is being heavily sold. And what we want to do, as I said, we want to buy the strongest against the weakest. This morning, I have the hourly of what we call our CSI, and the currency, we start with the individual currency that caught my eye. Well, there's a couple that caught my eye. First of all was the US dollar, obviously the most important one at the moment. And also there has been strong buying of the Canadian. And I'm thinking, okay, well, those two have been bought strongly. We look at the slope, if you like, of the line of the indicator, and the sharper that is and the more defined it is, that gives us also an indication of the strength. So there's obviously been some quite heavy buying and consistent buying of the US dollar. So we know the dollar is being bought. Various reasons for that, which I've explained, and we can go and look around and check our news feeds to find out the reason for it. And then we say, well, what is it being sold against? And what has been sold? Well, we've got it's been sold against the yen, as we can see here. But because we were coming into the European session, when I highlight this, you can see the times. That's 1 o'clock in this morning when we had that nice cross of the midnight and 1 o'clock on the dollar again. I wasn't around, but looking at the Swiss franc, 5 o'clock, 6 o'clock, we had this precipitous fall in the Swiss franc while the dollar was being bought. And that's what caught my eye this morning. So that's one way you can use the currency strength indicator. As I said, this is one that David and I have developed ourselves and available from Quantum Trading, our software company. The other way to use the CSI is if you are focused on maybe 1 or 2, 3 pairs, you can instantly see what the performance of those pairs has been in the overnight session. The hourly chart is just a really nice chart to get this snapshot. You can use the daily, but the daily is too slow a time frame. And of course, you can go down to the 30-minute and 5 and 10 or so. But the hour, I think, is just a really nice way of, as I said, just getting a feel for what the market has been doing up until you have the time to come to your screen. So I'm going to look at the dollar Swiss. I'm going to look at the daily. I'm going to look at the 2-minute. I'm going to look at the 5-minute. And the daily is really, really important because not only do we have the principle, some of the principles of volume price analysis, namely the price action and volume, but we have one of the third principles of the 5 principles of VPA, which is the absolute crucial element of support and resistance, and how you really must be aware of what is happening on the slower time frames, because that will have a direct impact on what is happening on the chart of your choice. Now, I'm going to stop there and I'm going to pass to David because I think he's got other things that he wants to focus on. If you've got any questions, please put them in the chat box. I'm more than happy to answer them for you. Shall I stop sharing? Yeah.
Yeah.
Okay. Stop share.
I'll mute. Hopefully you can all hear me. Just move. Oh, where that's come from. Get that out of the way. There we are. Can you hear me okay?
I can't hear you through my headphones. No, I can hear you.
Okay.
Can you hear me through my headphones?
Yes, I did. You probably have to change to Shure on your... I have. You probably have to change to Shure over there on your side. I don't know. Can I just check that you can hear me? I'm the pink man, as someone delightfully referred to me, which I think is wonderful. Because Anna cannot hear me in her headset, but hopefully you can hear me. If someone could just say, yes, you can hear me, that would be much appreciated. Okay. Thank you. Thank you, Julian. Thank you, Dalina. Lovely. Thank you. Okay. Better off here, David. Thanks. Great. Thank you very much indeed. Right. I am just going to move this out of the way so I can actually see what I'm doing. If I can. Right. Okay. Where are we? Where are we? Where are we? There we go. Okay. Anna's already mentioned the currency strength indicator, and I'm sure some of you here will be familiar with it, but please don't run away with the idea that it is an indicator that is going to give you instant entry and exits. What it's designed for, what we designed it for and developed it for, is to make the process of your analysis, really the starting point of your analysis, to make it as straightforward as possible and to highlight the opportunities for you quickly. And by that, I mean not only opportunities to further analyze a chart, but also for those charts which are not worth considering at the moment in the various timeframes. I have 3 timeframes here. The one on the left is 3-minute, the one on the middle is 5-minute, and the one on the far right is 10-minute. So like everything else, I'm just going to move that out of the way. Like everything else in trading, we use multiple timeframes, and the same applies to all the indicators we use, whether they're on a chart or whether they're freestanding, as is this one. So what does the currency strength indicator give you? How does it help you? And the way it helps you is to identify those potential opportunities. And I use the word potential strongly because that's what it is. These are potential opportunities which are setting up, which you then go and analyze in more detail across your timeframes on your charts. And I'm sure many of you are familiar with the fact that the way I like to use these indicators, I like to look at the extremes, because what's happening at the extremes is that is where currencies are potentially becoming either oversold at the bottom of the indicator, so down here somewhere, or they are becoming potentially overbought up at the top here. And what that means is that when currencies get to those levels, they are potentially setting up for some sort of reversal. And because the way to think about the currency market is that it is it's the purest market of mean reversion. And by that, I mean the state, the condition that a currency is in all the time is one of continuous change. It is oscillating up and down continuously. Now, clearly that occurs at different levels as we move higher up a price chart and lower down a price chart. But that constant reversal, that constant oscillation is occurring all the time. So a currency will never go to zero, unlike a stock which can. So what a currency is doing is it's constantly moving between these ranges, which, as I say, move higher and lower up and down the chart, but it is constantly oscillating. So the opportunities are always there, and it doesn't matter what time frame. This happens to be a scalping setup. As I say, I've got the 3, 5, and 10 here, so it's pretty fast. What we're looking for here is intraday scalping opportunities where we can find a currency, as I say, which is overbought or oversold. And the advantage of that is it means you get into the trend earlier, clearly. The downside is you have to be patient and wait. If you think about price action, all price action is, there are only two components to any price chart. There is congestion and there is trend. It's as simple as that. And if you deconstruct it to the smallest element possible, almost like splitting the atom, if you like, you could take that back. Certainly on TradingView, you can go sub 1 minute. For those of you who know us regularly, you'll know I love trading sub 1 minute timeframes. But you can take it back to an absurd level. For example, you could take this back to a 1 second. You could therefore break a 1 minute candle and look inside it down to 61 second candles and really see what is going on inside. And if you took that premise, if you like, all we are looking at is trend and congestion. So within any time horizon, from your fastest to your slowest, if you broke it back to your fastest, you will find you have congestion, a little bit of trend, congestion, a little bit of trend. And it goes without saying that markets spend a vast amount of time in congestion and very little in trend. Typically, it could be 80-20, perhaps sometimes even more. So 80% of the time we're in congestion, 20% of the time we're in trend. So it's therefore crucial that we identify those opportunities when they are arriving, because we don't want to trade in congestion. We want to trade in trend. We want to pick those trends off. Therefore, when the currency is getting to the top, as you can see here, the yen, for example, this magenta line, it's getting up to the top here somewhere. Equally, we've got some moving to the bottom. We've got this orange line seems to be moving to the bottom. When we move right over here to the 10-minute time frame, what do we see here? We saw the Swiss franc got all the way down to the bottom here, very, very heavily oversold, and now has started to climb quite strongly. Counterbalance that with something like the pound up here, and I could tell you without looking at the chart that the pound Swiss on this time horizon, remember we're only looking at one time frame here, we're looking at 10 minutes, so around and about the 10 minute, maybe 5, 10, 15, something like that, we have got a decent trend going. I don't need to look at the chart. This is what the currency strength indicator is telling me without having to do a lot of searching around, a lot of hunting around. So it will shorten your analysis the whole time. Plus, it will show you where to go hunting next. Now, if you're happy with jumping on a trend that's already underway, jolly good, because the pound Swiss will be in a strong trend. And the reason it'll be in a strong trend is because the pound on this time frame is falling quite strongly, and the Swiss on this time frame is rising quite strongly. So there is a nice trend there. How long that trend will develop, we don't know. What we will do is we will go and look at what is going on in our time frames down here. And remember, whatever you see on a slower time frame has yet to incorporate some of this price action. So the fact we've seen this strong rise on the 5 and we're seeing that on the 10 is great. What we're seeing at the moment on the 5 is a slight pullback on the Swiss franc and a slight inversion on the pound. So we're starting to see a congestion phase building here, because what's happened is the pound has stopped falling and is starting to try to rally a little bit. And equally, the Swiss franc has stopped rising and is now starting to fall a little bit. Now, how that will play out over here could well be just a little dip here before it carries on higher and this carries on lower. We just have to wait and see. And of course, over on our 3-minute time frame, you've got the much more granular view of that, where all of this is unwound in very close detail, very close proximity to the market. And what you can see going on over here, for example, if we were just to quickly look at these, we've got the euro, the orange line, which is falling very strongly. And that's falling against quite a bunch of currencies. It's falling against the Aussie, it's falling against the pound, falling against New Zealand, and falling against yen, which are all rising. Now, if you were to look at a Euro-Swiss chart, and this is where the currency strength indicator helps you to give you information as to where not to go looking, in this time frame at any rate, we have the euro, the orange line, and the Swiss franc falling together. What does that mean? That means that there is very little trend there. In fact, probably none at all, because the two are going in the same direction. And therefore, there will be congestion at that point. Remember, this is only one segment of time we're looking at, but you've got the same going on over here, where you have the euro falling and the Swiss franc falling. Over here, it's less clear cut. It would be in congestion. But where these two rose together, the same principle would apply, because when the two are rising, the orange and the green are rising, there's no differential energy driving those two currencies in opposite directions. And that is what you're looking for to identify those strong trend opportunities. And that is why when you get the two currencies, individual currencies, setting up at extreme points, as we saw here, where we had the yellow one, the pound at the top, and the Swiss franc at the bottom, provided they fall, and they fall strongly with a steep gradient, then that is going to deliver the strongest trend for you across that time frame. And that is why I like looking at the extremes. It's always the place I look at first to identify opportunities, because I'm happy to be patient and wait, perhaps for some congestion to follow. And then at that point, once it starts to break down, I will jump in. Now, there is a downside, and the downside is I have to put a little bit more risk on the table, because I have to allow for that congestion phase that always occurs at the top and the bottom. All I can be assured of when a currency gets to a strongly overbought or oversold is that it will move. It has to, because it can't stay there forever. No currency can. Now, it may stay there for a little while, and in staying there for a little while, I have to allow for that, and I allow for that by setting a wider stop loss. In other words, I have to put a little bit more risk on the table, but my payoff is that I get in at the start of the trend. And that's my reward, if you like. For putting that little bit of extra risk on the table, I get paid with a reward of getting into that trend much, much earlier. Because you, as a trend trader, if you don't want to take that approach, but you want to jump on a moving trend, you only have to put less risk on the table, because your stop loss will be that much closer. So if you're jumping on a trend, let's say you're a scalping trader, and you maybe put 5 or 6 pips at risk on that trend because it's underway and has some momentum already, which you can see, and it's been confirmed with volume. Maybe we've broken through a level. As Anna said, levels of support and resistance are absolutely essential. We've broken out a congestion phase. Maybe volume is rising, and we're jumping on that trend now. Your stop loss is much tighter, whereas mine would have had to allow for that congestion phase, and therefore I might have had to put say 10 pips, possibly even 15 pips on the table. But I am now reaping the benefits of getting in early. So that's the currency strength indicator. We use it across multiple time frames. I won't go into the other indicators at the moment because I just want to pass back to Anna, so you have different change of voice and different screens to look at. So I'm just going to switch off there. I'm just going to stop sharing. And I will mute myself.
Yeah, sorry. Right. I mentioned earlier about the Swiss franc and why I had selected it because of what I'd seen on the currency strength indicator. But then I also mentioned that the importance of looking at key levels of support and resistance. And this is something that you might like to consider yourself. We have lots of ways of judging, marking up the structure of the chart to tell us where those important levels are. You can use those of you who are familiar with the quantum trading tools will know we have a volume point of control, which also brings volume into it. We have what's called an accumulation and distribution indicator. We have support and resistance indicators, which calculates this for you and draws the line. And we have the all-important Camarilla levels, again, calculated for you, and just to make our life easier. But one of the ways you can start is simply by doing it yourself and eyeballing it yourself. And the reason for doing it yourself is it allows you to look back further on the left-hand side of the chart to take in a longer period, because as traders, and it doesn't really matter whether you're a day trader, an intraday trader, a scalping trader, a swing trader, even as an investor, we don't spend enough time looking at what the left-hand side of the chart is telling us. And the reason I've put up the dollar Swiss is that if we look at the price action that we're looking at the moment, going back to the beginning of January, and we can see, without even having these lines that I put on here, we can see with the dollar Swiss a classic VPA signal setup. We have a fantastic shooting star on the daily chart with above average volume. Now, that of itself, even without the volume, would tell us this is one of the strongest candles in candlestick theory, because we can see here the price try to rise and then it fell back, and we have this very deep wick to the top of the candle. And the probability that the price is going to, at the very least, I wouldn't say reverse immediately, but certainly there's weakness coming in to this market. That alone tells us. And when we put that with the volume, as we see here, it's above average. I actually have an average line that I've added onto the volume. This is just the standard volume, up down volume from TradingView. And on the daily charts, I have it set at 20 period. On the faster charts, I tend to have it on the 9 period. So for those of you who may be interested in that. And what happened following that shooting start? Well, if we actually look at the candle of the next candle, the price didn't fall immediately. It opened slightly higher, and then the next day it fell, and it was supported on good volume. So this is the daily chart. So if you are you're a day trader and you see that on the daily, what is your expectation for the next day? Your expectation is this pair is going to suffer some weakness. So would you be looking to trade it on the long side or the short side? The chances are the better trade would be to the short side. Doesn't mean to say that there are opportunities in that down count. There would have been opportunities to trade it to the long side. And when we look at what the dollar index was doing at the same time, that was when it was kind of peak dollar index around Friday the 10th, and you would go and have a look at the Dixie. But if we scrunch the chart up, we suddenly see, oh, going back to April 24, we have a double top. A double top pattern is one of the strongest patterns in pattern philosophy. The chances are that the chance that is the probability that is going to play out is reasonably good. It's certainly more than 60, maybe even 70%. If we scroll back even further, oh, look, we've got a triple top. 1, 2, 3. That's even more of a confirmation. A triple top is even stronger than a double top. As we say in VPA, this was a ceiling. If the price ever gets back up there and goes through, it becomes the floor. Those of you who have read the book will know we talk about floors and ceilings. Ceilings become floors and floors become ceilings. There is, to my knowledge, there is no indicator. There is a chart pattern indicator, to be fair, on TradingView, and there are chart pattern indicator software out there that will do this for you. But eyeballing it yourself and looking at it, okay, and looking at the reaction from those at those past pieces of price action will tell you not only to give you an insight into how strong these patterns are, but also tell you that the dollar has come to some kind of peak because we have this triple top here. So that was the first line. And then it's a question of looking at, well, where did it stop? I didn't actually have those at the time. And I look at that and you look, well, it kind of, that looks like an interesting place, and go over there. And we had some resistance over there as well. And then it became a floor, a ceiling, then became a floor, and we go back even further. So it's a bit like drawing a trend line. When you draw a trend line, you can't just use 1 point, you can't use 2 points, you try and find maybe 3 or maybe 4 points in the trend line. I'm doing a trend line, but I'm doing a horizontal one. So, and what this also does, as David explained earlier, it gives you those all-important congestion areas, and you can see them. This is on the daily chart. You could break this down even further and look at the faster timeframes, and you can do exactly the same exercise, and you will see those congestion zones, those breakaway from congestion zones, where you have the resistance, where you have the support, where you have the floors, where you have the ceilings. Now you could say, well, do I draw them at the top of the wick? Do I draw them in the body of the candle? And to be honest, there is no hard and fast rule. Sometimes, you have to see what the cluster of candles is telling you. Clearly, if you have a lot of wicks to the bottom of the candles and you have a whole collection of them, then that is, you probably say, well, okay, go somewhere towards where the body is. But where you have a mixture, it's really down to personal judgment. And the other thing to bear in mind is with these lines that they're not rods of steel. You have to give them a certain amount of leeway. And if we look at this here, this is a classic example. Now, this is yesterday's dramatic a price action in the markets where we had the big fall in the US dollar, and look at the tail on that candle. But if you look here, we see it actually went through that support line. But if you look back, you can see that just above there, it actually bounced here, it bounced here, it sort of bounced here. You had a congestion period, it held. You had this congestion phase, quite a long congestion phase. We had it sort of here. And what do we have here? Let's go back a bit further. Yeah, we've got support here. Do you see what I'm trying to explain? I hope that comes through to you and explains why it's so important, I think, to do this manually on the daily chart. You can do it on the other time frame, but the key thing about the daily chart is this, is when you're down on the 2 minute and the 5 minutes, and one of these levels appears, you really do have to take notice, and also what the price action and the volume is telling us. And clearly yesterday, with the great big wick to the bottom of that candle, and you had a ton of volume coming in and it came off this line, what do you think is going to happen today? And indeed it did. Now, because the forex market is 24 hours, we all come to it at different times, and there are 3 very distinct sessions. Did this happen in the Asia session? Did it happen this morning in the London European session? Is it now going to carry through into the US session? And this is where, in some ways, this market has been it's been marketed in a quite a disingenuous way. It is open 24/7, 6.5 days a week. It starts on Sunday evening. And in theory, you can open your laptop or your computer at any time, and you will probably find something to trade. But in reality, what you should try and do is dedicate a set amount of time to a session that suits you, that suits your lifestyle and suits your time zone. So we are very fortunate here in the UK. We have the luxury. We can trade the European Open and the London Open, or we can be at our desk when these 2 markets come on board. We have the tail end of Asia. We can then wait until New York comes on board. So we have that luxury. Not all traders do. But if you can dedicate a set time, see it as going to work and say, this is my work. I start at a certain time and I finish at a certain time. I think you will find it will give you more success, because it will give you that consistency, and it will also give you an insight of, in that time block, of what actually moves the pairs, the currencies at that particular time. Now, this week, of course, we have huge news. We have earnings from some of the top tech companies. We've got Microsoft, we've got Apple, haven't we, David? We've got, I'd have to look on the earnings calendar. We also have the FOMC, what the Fed are going to do about interest rates. The probability, it's almost 100% that they are not going to raise interest rates, despite what the Donald has been has said last week. We are also now in a very different era, politically, economically, and from a market perspective as well. It's no secret that Donald Trump is not a particular fan of Jay Powell. You can't actually get rid of him because under the rules, he is there until 2026. He did, but what you see in front of you and what goes on behind the scenes, who knows? With that being said, what is the most important part of the FOMC release is the press conference, because the questions will be to Jay Powell as well. When are you going to lower interest rates? What's the consensus of opinion? And about interest rates in general, this is just a general opinion. With interest rates, if they start cutting aggressively, there's something seriously wrong with the economy. One of the reasons why they're hesitant in lowering rates is that on the surface, according to the data that they follow, or the data that they use to make this judgment about interest rates, the economy is doing really, really well. Well, certainly better than it is over here in the UK, though that's not difficult at the moment. It's a case of, well, the employment market the jobs market is the one that is showing resilience. Now, whether you agree with the data, how it's presented, that these are only part-time jobs, we could discuss that until the cows come home. But the key thing is how the market interprets that data. So what you think about the data, whether it's manipulated, whether the statistics are manipulated or not manipulated, but they're presented in such a way to give the impression that the employment market is stronger than it actually is, and it doesn't correspond with what's going on the ground with individual workers. That's another discussion. It's what the market believes. It's how the market reacts. And if the market thinks that the economy is fine, it's all hunky-dory, the market will respond accordingly. Though, a caveat to that, the stock market is not the economy. The two are very, very separate animals. So, having said that, looking at the daily chart, what I have down here, I have the 2-minute and I have the 5-minute. And on the 2-minute chart, I have, this is a new indicator for us. It's been around some time, a long time. It's the VWAP. Our version gives you 5 different versions of the VWAP. Yes, so it's a 5-in-1. This is for TradingView. The great news is it is now available for MT4, MT5, and I have a feeling we are the only company able to offer that. And the VWAP stands for volume weighted average price. Those of you who know us come along, we don't really use moving averages, not because we've got anything against them. We just don't. We have other ways of judging price action, obviously with the volume. But the VWAP is so crucial, particularly in stocks, and it is used in the institutions in stocks because it gives them a kind of benchmark for value, if you like, for a price of a stock. And we thought, well, why can't we use it in forex? And which is why we have developed it. It's those of you who use Bollinger Bands, you'll know that you have a moving average in the center, and then you have standard deviation. This is the standard, but you can adjust that standard deviation to suit yourself. And the rule of thumb, and you've got to take this with a pinch of salt, is if the price is above the VWAP itself, which is this yellow line, the market is bullish. And we have to always confirm that with what is the volume telling us? If the volume is, have we got some anomalies? There's a great anomaly here. It actually broke away from the VWAP here. It went above. This is the first band of the week, which is one standard deviation. It actually went up. It triggered the volatility candle. Volatility always comes in when you have some momentum, but as it's also used as a great opportunity to trap traders on the wrong side of the market. What happens is you've got rising volume, you've got rising prices, great, but because you've got the volatility triggered, the expectation is we are going to get a retrace into the spread of the candle, and we're going to get some congestion. And guess what? That's exactly what we got. But the price carries on. The top of the candle, the bottom of the candle is also becomes support and resistance. The good news is, yes, it went through the VWAP itself. And this is what is also quite important with price action. And that is when price comes to one of these important levels, because the VWAP is an important level, just as our support and resistance was that we marked up on the daily chart, is you always find that it needs that extra bit of push from the volume. So if you have a key level, however you've marked it manually, a VWAP, Camarilla level, you will tend to find if it's an important level, you need that extra bit of fuel, but when you get that sudden burst, it then contracts, if you like. You get this contraction in the momentum, and that's when you get the reversal into the candle. And then you have to pay attention to what the price action is doing and what the volume is doing. It carries on, it does. We get a little pullback back to the support, goes higher. But this is then becomes somewhat concerning, because you have a huge injection of volume into that candle there, a fall off there. And that is kind of telling you that, yeah, it's managed to lift itself off the VWAP, but it's a bit of a struggle, because that's an anomaly. For that amount of volume, that candle should have been up here somewhere. What price action and volume tell you? It gives you a narrative of what is going on. And if you understand that narrative, and you can follow that narrative by reading what the price action and volume is doing, particularly on the anomalies and what happens to the price action when it's in conjunction with the support and resistance, you don't then have to be frightened out of any position that you may have taken. And all these indicators, whatever they are simply there to give you, just to help you to frame that price action. But ultimately, what will determine whether this move carries on higher is the interaction between the price and the volume. And that's, and I don't know whether any of you know, but David and I do now take on students privately. We offer a one-to-one. It's actually 2-to-1. There's 2 of us and 1 of them. And this is what we spend huge amounts of time with our students, is really, really getting to grips with the nuances of volume price analysis, because once you have it firmly entrenched as part of your chart analysis, everything else just flows from it. But indicators are great. They're there to give you these heads up. They fire at certain times. They will fire as a signal, a potential setup, but it's the volume and price which will then determine whether that's going to go higher or not. Now, what's interesting is we have had this trend higher, just using, we've just been looking at the VWAP, but it's not a smooth trend. It's been quite a scrappy, quite a choppy trend. Why? Because we've had volatility candles coming in. But looking at the volume profile underneath it, the positive thing is that it has, there've been injections of volume to kind of push it up and push it up. But it's had a lot of pullbacks and a lot of congestion phases. As David says, it's trend, congestion, trend, congestion. And at the moment, we are in congestion. Why? We're around the volume point of control. Now, this is just the 2-minute chart. What we can do then on the 5-minute chart is, I expand that data. When I said these levels, I use different time frames and I have different indicators on them, because I don't want to overclutter one chart. So it's better to have more charts, different time frames, and use different indicators. And I said to you earlier about the Camarilla level, and this is a huge level, the R3, and we can see here we had, where was it? This was overnight, so that's what happened but it's interesting to have on the chart the Camarilla levels that we provide through quantum trading. They are recalculated every day up to the hour. The hour up to the day and the week, I believe, are calculated once a week. So again, key levels, look at the hour. Sometimes price just stops, which seemingly for no reason whatsoever. Is there a particular reason for that? And that could be because it's hitting a key level on something like the hour, or as we could see earlier on the day. So we had this nice bounce. We had a sort of, say that's a double bottom down there, but it's really about 6 o'clock this morning, 6:30 this morning. This is the trend higher that I looked at. Then we had this injection of momentum and volume here, but it ran straight into the volume point of control. Sometimes, when you look at a chart like this, all you see are roadblocks everywhere. You think, oh my goodness, there's a level I've got to be aware of. There's a piece of news I've got to be aware of. But that's the nature of this business. But if you understand what you're seeing in terms of price action and volume, and you use it together with the tools that we believe will help you support your VPA analysis, there isn't any reason why, first of all, you could become a successful trader, but much more important than that is you will become a less emotional trader. The thing that really kills people's ambitions in this business is their overreaction to what they see on the chart. They get panicked, they get frightened, then they lose, and then they revenge trade. It helps you, we believe, manage those emotions. What we've done with our indicators, what we will be doing is we're going to be putting together a little package which we will call specifically VPA indicators. They will include the Camarilla, they're going to include the volatility, they're going to include the VWAP, and two others which we haven't quite decided, because we really feel... VRSI. And there's a new indicator called the VRSI, which I haven't got on my charts, but could you want to have a quick look at it, David? No, well, maybe we'll do it next time, which is the volume relative strength indicator. You start with VPA, and then you have these beautiful tools just to give you that extra advantage, if you like, in your trading. Anything else you want to say, Dave? And I pass to you. Okay. Hold on, just check myself off. Where am I?
Mute. There we go. I'm unmuted, hopefully. I've just gone to the Euro Aussie, and the Euro Aussie is an interesting pair, and I've chosen it for several reasons, in fact, just to have a quick look at the charts. You can see here I've got 6 different time frames. From the very fastest, this is 30-second, this is 1 minute, this is 3 minute, this is 5, 10, and over onto the daily. And as I say, I've chosen it for several reasons, not least because when you think about time and what it is you are going to be doing in that chosen time horizon, let's just move that out of the way. Let's just pop this one up full size. There we go. There we are. This is 30 seconds, remember. This is what an out-and-out scalping trader might be looking at. And they might be joining some of these trends. And certainly, let's pull that right the way across. This was 9:30 our time, so a little bit over an hour ago. And whether you define that as a trend, however you define that, it is a trend. It's a trend. It's in 30 seconds, but it's perfectly tradable. Absolutely tradable. I'm not going to go through all the VPA lessons in here, but there are plenty of them. And it all starts off with this wonderful volatility trap at the top here, with the volatility indicator, which is just such a simple indicator and is so powerful. It will keep you out of trouble because it signals several things very quickly, not least of all the fact that we have volatility because it's looking at the price based on average true range. But much more importantly than that, it's giving you information about the participation of the market makers, whether they are participating and whether they are not. And to pick up on what Anna was saying about emotion, emotion is the single lever that they will use many, many, many times a day because they know how potent it is. It's an immensely potent weapon for them, and it makes them an absolute fortune. Because what happens is, and you can imagine it here, very simple example. This has been perhaps the dear old scalping trader's been sitting here through this, very frustrated, and then this happens, and on we go. And then what happens at the top, even better for them, the market snaps up very quickly. It jumps. And there'll be people who've missed getting in early, and they'll be saying, oh, great, time to get in. Oh, marvelous. We'll make some quick profit. Wrong. Because what happens with volatility is that the market makers will do one of two things. They'll either move into congestion or they'll reverse it, as they did here, both of which are extremely painful to sit through from an emotional perspective, and therefore not something you want to do. The market makers understand that. They've been doing this for decades, centuries. They understand the power of emotion, and they understand the power of missing out, FOMO, the fear of missing out. And that is what this is all about. We had one to the downside here, exactly the opposite. Trap move, down it comes. Everyone jumps in short. Oh, we've got to the end of the trend. No, wrong. Off up we go. You can imagine the power of that indicator, and it happens relentlessly, and it happens in all time frames. And I'm also going to show you on this particular chart on the daily, which is why I've pulled it up. But the fact of the matter is, this is a trend, and there would have been scalping traders making very respectable amounts of money here, no problem at all. Now, if we scroll over to, let's go to our 10-minute time frame, very slow in comparison, of course. What will our 10-minute trader be doing here? And the answer is not a lot. The probability is that they will have a level somewhere here where my cursor is, and possibly one below here, because what's happening is the price is bouncing off this very strong platform of congestion over here, which is acting as support. And you can see it here, what you would expect to see, which is why we always look at the left of the chart. And if we're looking to go long, let's call them not a swing, well, let's call them a swing trader. They're looking for a swing up. So they're waiting for something to happen here. And what this brings into sharp focus is this whole business of where do I sit in this market? What is it I am trying to do? You have to answer that for yourself. And you have to be very, very clear when you go into a market what it is you're trying to do. If you're a scalping trader on 15-second and 30-second, you would have made very nice profits in that trend. If you're a slower term swing or trend trader, which is even slower, you will be doing nothing right now. You will be sitting here and waiting. And this is what you have to understand, because in every time frame, there will be something happening for somebody, and it may indeed be counter trend against the dominant trend. So what that trader is doing on 30 seconds may ultimately be against the dominant trend, which will be in the opposite direction. And you have to consider this in your mind the whole time. First of all, what am I trying to do with this trade? And secondly, where does it sit in this axis of rotation where we have on one time frame, in a very fast time frame, something happening, and on a slower time, something entirely different happening in a different direction. And it is keeping those ideas in mind and deciding where you sit and what it is you're going to do on this occasion. It doesn't mean that you have to always be a scalping trader. It doesn't mean you always have to be a trend or a swing trader. You pick and choose. For some people, they prefer to only choose one approach, one tactic, if you like, which they use all the time. It's absolutely fine. But for us, we chop and change. It depends what the market is doing. And remember, in congestion phases, if you want to trade in congestion phases, if you feel compelled to trade in congestion phases, you will have to go down to the faster timeframes. You have no option, because that is where all these trends are building in these little phases of price action here. What you're doing as a trend trader or a swing trader is waiting for those longer term opportunities to arrive. So that's on that time frame. And if we go down, what I wanted to show you very quickly on the daily is the power of that candle, and also bringing another aspect. This is what we have on the daily. We have a huge volatility candle to the downside. And what that is telling us is that we expect to see a reversal, a congestion or potential reversal at some point. Now, when you see a signal, and it doesn't matter whether it's a volatility candle, whether it's a level of support and resistance, whether it's a volume point of control, doesn't matter. On a slower time frame, it will carry more weight than on your faster time frame. So when you see these signals on much slower time frames, let's suppose you're on a 5-minute time horizon and perhaps you've got an hourly chart up and you get a volatility trigger, that is hugely significant and you need to pay attention. The beauty of the indicator is that it will trigger in real time. And by that, I mean the little purple triangles will appear within the time frame of that candle. So you don't have to wait until the candle has closed. If you're on a 5-minute time frame, they may fire off in the first minute. Tells you instantly that you've got volatility. The market makers are participating, they are moving the market, and therefore you need to pay attention and decide what to do. If you're not in, you stay out. If you're in, you take your profit. If you're in profit, you take your profits off the table. It's as simple as that. And in terms of getting back into the market, if you've had one of these significantly in an area close to where you're trading, you wait until the price action has cleared either the upper level or the lower level, not the body, but the wicks. In other words, at that point, once the price action has cleared those two regions, we can then safely assume that the volatility that created that piece of price action has now dissipated and we are back into more normal price action. And you will see these in all time frames. If you want to see them at their most extreme, just log on to the cash markets open at the start of the US session. Volatility upon volatility upon volatility over the first 30, 40 minutes. You will get these in every fundamental news release in the Forex world. You will get them at every single session crossover, because when we come out of Europe into London or from London into the US, it's another prime target for the market makers to move the market about rapidly, to trap you into a weak position, and then to reverse against you. It's very, very simple. And don't cry about it, because if you were a market maker, you would do precisely the same thing. I'm going to see if I can change tabs without logging out and back in again. That's the CSI we were looking at earlier on. It's moved on. We've got very strong buying in the yen here. You can see this magenta line. And the reason I highlight that is because there's a couple of indicators I want to do before we wrap up. This is what I've done here. I've isolated out on the Japanese yen here. This is the currency matrix. And alongside that, I've got the currency heat map. And I want to just spend a couple of minutes on these because there is to clarify what their purpose is, because it is very, very different in the way they're constructed. If we start with the currency matrix, I've got three here. I've got one on 1 minute, one on 3, and one on 5. So very quick again. And what the currency matrix does is it works very close to the market. If I show you the look back period up here, just on settings, you can see the look back period here is 7. I've got it isolated on the yen, as I said. And what that means is this indicator works very close to the price action. In other words, it's only looking at the last 7 candles, last 7 bars. Whatever the time frame may be, that is the metric. So if you're on an hourly, it'll be looking at the last 7 hours. If you're on a 1 minute, it'll be looking at the last 7 minutes. And what it's giving you is a heads up onto sentiment, universal sentiment at that point for that currency. We've isolated on the yen. And if all the market is selling the yen, then they will all be up the top. If all the market is buying the yen, they will all be down the bottom. And they were a few minutes ago. All these little orange ones were all down here. They were stacked up very, very neatly, all down at the bottom. In other words, on a 5-minute time frame and there or thereabouts, the entire market, in terms of yen pairs, was buying the Japanese yen. And now we're starting to see that shift. And these are starting to lift off the bottom, which means there's been a rotation in that sentiment. And the market, as you can see up here on the 1 minute, is now universally selling the market very quickly. And in a way, you can think of this like the currency strength indicator, where this block over here, which is now starting to lift, we are starting to see that shift in sentiment appear on our 5. It's already pretty well developed on 3 because they are well up the ladder here. And over on 1, they're all stacking up at the top. So what we are seeing is a very nice rotation from one sentiment where it's bullish to bearish or bearish to bullish. And this is the way to use the indicator. It is very much a scalping indicator. It is there to give you, again, information which will help you understand the sentiment towards that currency that you are considering. So whatever yen pair you are considering at the moment, they are all doing the same thing, which is great from a risk perspective because it means the risk on that trade is lower because the entire market is doing the same thing. If one of these, if the Aussie yen was down here somewhere and all the others are up there, that's a worrying signal if you're trading the Aussie yen because it's doing something completely opposite to everyone else. But at the moment, what we're seeing is this lovely rotation from one sentiment state into another, moving through from the slower time frames into our faster time frames. Alternatively, you can think of it the other way around, where the faster time frame is now taking control and is starting to drive that sentiment through to 3 and drive it through to 5 as well. But remember the point. This is very much a scalping tool. Now, if I move to the next window, let's move this out of the way so I can get at it. And that's in the way as well, which is a pain. Move that away as well. Right, if I go to the next window, this is the currency heat map. Now, the currency heat map is very, very different. And it's very different for 2 prime reasons, even more so on TradingView. And the reason it's different is because, first of all, it has a much longer look back period. And if I click on here, you can see, sorry, on that one, I have got a shorter period. But typically, it will have a much longer look back period, certainly on MT4 and on the other platforms. The reason this one is different, I'll explain. But the primary difference with a heat map is that the ranking here of the currency pairs is weighted, and it's weighted by time. And what that means is that the greater the time, the more significance it will have in that weighting. So the 30-minute will have the greatest weight, and the 1 minute will have the least weight in the context of where these currency pairs sit in this ladder. And that's what you always have to remember. So this is much more towards a swing or trend trading approach, where you are taking a more considered view of the world. So the Aussie yen down here, although it may be at the bottom, and it could have been at the bottom on the currency matrix, what is unlikely to happen here, and you can see here the same effect. We've got all the yen pairs stacked down here, but they are, for the moment, they are staying here because they are being weighted by this negative sentiment, the red cells, under our 30-minute column. But gradually, if that changes, what you will see is you will see a migration from green, from red, beg your pardon, to green. And that's what we're starting to see the first shoots of that appear here. We're starting to see these green cells populate. And if this sentiment develops some strength, and this is what it's all about, then ultimately what will happen is that green sentiment will start to migrate through and across to all these other time frames, and gradually those pairs will then start to lift. And hence you can get a feeling that this is a much slower context of time that we're considering here. So we are much more in the swing and trend trading environment, whereas the currency matrix is the environment for scalping. Now, what I've also got here is I've got 3, as you can see. And if you look across the top here, they've got different time frames. We've got 15, 30, 1 hour, 4 and 1 day. And we actually go down to a week over here on the opposite extreme right. And that is unique to TradingView. You can't do this with MT4, unfortunately. With MT4, you have to work with the timeframes that we allocate. But with TradingView, you can. So you can tailor this very much to how you want to approach your trend or swing trading in terms of market analysis. And I use it in exactly the same way. I look at the tops and bottoms because I like to look at extremes. What is oversold? The yen pairs predominantly. What is overbought up here? Not so clear. We've got some pounds overbought and then the euros up here as well and some dollars up here. But, it's not that clear cut because some of the dollars down here haven't actually moved to the bottom. So, that's maybe something that pay great attention. And over onto this one, you can see we've got a stack of pounds here, very strongly up at the top. The pound yen is still negative, but these are all relatively green. Cable, you can see, has got quite a lot of red over here, but it's being heavily, the reason it's up here is because it's being heavily influenced by the daily. And this is the beauty of the indicator. It gives you that weighting according to the time frames. And therefore, as I say, on TradingView, you can tailor it, but on the others, you can't. You use the time frames that are there, but it's all to do with weighting. So when you have these slower time frames, these will move much more slowly. You saw them hopping around on the matrix, and they hop around very quickly. On the currency heat map, they will move in a much more leisurely way. So you might expect to see, for example, some of these start to drop off here. Maybe they'll move a slot or two in a day. Maybe tomorrow they might be 3 or 4 slots lower, something like that. And that is how you use it. It's just it's a very elegant indicator to bring all this information together on one simple screen where you can look at it and then go and analyze it. And it also gives you a heads up into which are overbought, which are oversold, and also towards sentiment, because we want to see whether that sentiment is universal across the pairs or not. And you then use it in that way. As Anna said, and we both say the same thing, indicators are there for help, support, giving you information quickly. There's a huge amount of data on here, huge amount of information, which you'd have to have multiple workspaces to have this all over the place. But you can change these time frames. If you click on the indicator as just in the settings, just to wrap up, there we go. This is where you can set your time frames. And so you can literally tailor it to whatever it is you want to do. You could have, I don't know, 1, 2, 3, 5, 15 over here if you wanted to. It all depends on how you want to set yourself up as a Forex trader. Right. We've got to the top of the hour there. I think we're going to call the session to an end at that point. I think I'm just going to have a quick look and see if we've got any questions. Just stop sharing there. Just drop that out of the way. Let's have a quick look. Yeah. There we go. Yes, indeed you can. As Julian Danilat has said on in the chat, that's exactly how you can use the heat map. It's a very elegant way, I think, of using it. So
we'll do more sessions.
We will be doing a lot more sessions. We'll be doing more sessions of these. We will be trying to do them regularly. Probably this day, maybe Tuesday, Wednesday, something like that. We'll do them, try and do them once a week for you, and in this similar format. So I hope you've enjoyed the session, and enjoy the rest of the trading day and the rest of the trading week. Certainly an interesting week ahead, and we will see you again soon. So bye for now. Thank you so much for coming on. Much appreciated. See you soon, and bye for now. I honestly don't know.
Did you end meeting at the bottom?
Oh.